One of our members had asked me to make a video maximizing selling covered calls when you don't want to sell the underlying. Now, this is easy. You just roll it. You just roll it for infinity. And I'm going to explain the mathematics behind that. I do this with cash secured puts. I don't want to have to buy the shares. Cool. I'll just roll it out to another strike. Further out strike, further out expiration. And it immediately covers the loss because you're receiving more back, cleaning up the mess that you're in, and you just roll it forever and ever. Kind of like the Fed does, right? Where they just kick the can up the hill. And whoever's in office. Let's take a look at Mara. I have 100 shares here for the sake of covered calls. I believe there might be a little bit of a pullback sometime this month. Well, there was, but it bounced right back. I'm up around 2% on the shares. And the Mara covered calls, I'm up 52%. So what I'm doing, for those of you that don't understand, I don't want to get too off topic because this video is for him, is I'm betting where a stock won't go and I get paid. The less it's worth, the more I make. I want it to expire worthless. I don't want the price of the option to go up higher. I want heavy theta decay because I'll profit off that. So in theory, I'm picking a losing play. That's it. So over here, now let's go over tomorrow. I'm selling what am I selling here? I am selling the $12 call for next week, which I'm hoping will expire worthless and I can do it again. Let's say Mara decided to shoot up and I did not want to lose the shares. Very, very simple. You know what I would do? I would come over here, roll this position. See this right here? Roll this position. Okay, let's say Mara was at 12. Doesn't matter if it hits 12, I'm not going to lose the shares. You're not losing them for free, guys. Keep in mind, they're buying them from you for 12. That's cool. Well, I bought them for like 9.80, so I make profit, but I don't want to lose them because Mara, in my opinion, should be around 40 to 50 bucks, maybe as high as 80 in the next year and a half with the Bitcoin halving coming. But let's take a look at this. Now, let's say it shot up. I sold this. Let's pull up a calculator so we can understand. I sold the call, let's say for 0.25. Okay, that's times 100 is $25. Now let's say it's in the money and now it's 50, which means I'm down $25. So how am I going to fix this? How will I fix this mess? All right, we're going to pick a new position. I'm going to go out. Let's say I rolled out to, I want to sell higher than 12. Well, that's to say I can't really do that right now because these contracts aren't paying that. But let's just go out to December 15th. All right. Let's say I want to roll it to a $13 strike, further out of the money. If Mara shoots up to $12 from 10, these should be at about what? Let's see what an at the money call would be. At the money calls are $1.12. So you can expect this $13 strike to be about, $1.10 to $1.20. Let's pull up the calculator again. Okay. So I'm going to get back, let's just say, because the 10s are at 112, I'll get back 112. 112, and I'm down $25 because I sold it at 50. I sold it at 25 and now it's worth 50. That's a negative $25. That's if I get out of the position. If I hold the position, it doesn't matter how much it goes down. I'm still getting that 25 bucks back. It's still profitable overall. They're buying the shares more than they bought them from me for overall. That's if I want to get out. If I touch it, then I'm going to lose, right? But let's say I do want to touch it and I am going to lose, but for about a second, right? Because we're trading it. Not really when you're rolling it. So minus 25. So that's an $87 return still. And I can keep doing that. Well, now I'm up 87 bucks. I just received 87. I realized a $25 loss and I got paid immediately $87. Now let's say it wants to keep going higher. Okay. You want to play this game? I'll just keep rolling it. I can roll out to, and in reality, I could have just rolled it to the next week for just a further out strike and it would have covered the losses. You know, I don't necessarily have to go that far out in the date. It wants to keep going again, I'll roll it up another strike. But you need to do the math. How much are you down and how much are you getting back? If I paid $25, if I got paid $25 in credit, I don't want to sell something for $10 in credit, right? To receive back $10 because that's a loss overall. I want to receive back more each time. This is the highlight right here. I want to get back more each time I roll the position. I want to get back more than my loss. So if I'm down $20, I want to get 25 to 30 bucks. If I'm down 50 bucks, I want to get back 55 to 60 bucks, covering that, right? And I can just keep rolling it and rolling it and rolling it and rolling it, right, to a further out expiration, because the further out the expiration goes, the higher the contracts pay you, right? Now, if I don't want to lose the position, there's another way. I can just turn it into a debit spread, right? I can turn it into a credit spread. I can turn it into a calendar, or let's see, I can turn it into a calendar spread. There's multiple ways to go about this. Because then if I turn it into a debit spread, I'm kind of freeing it up, right? I'm freeing it up from those shares to where it's now just a debit spread. So let's say, and there's an advanced way that I can do this. This is getting really advanced stuff here for Robinhood. So here's the other way. Now that's the simple way. I already rolled this position. I was in 11s, I think. And it started to rip and I was like, "Oh no, that's I was in 11s for 11.17 and I was afraid it was going to go there. So I rolled it. Now, does it matter that it didn't? No, because I was going to be in another position anyway. So I rolled it up. I should have just held it, right? But I was wrong, and I'm still not paying for my mistake because I'm on the sell side, right? My probability comes up so much. So I could then let's go over here. I can turn this into a debit spread. This is very hard to understand. Only advanced traders are going to be able to understand me on this. So you new guys are you're not going to be getting this. So I'm in a Mara sell, right? What I would do is this. I would first roll this up, okay? I would roll this position, let's just say to, December 8th. Get paid some money. I'd probably be getting paid, if I went a little bit out of the money. This thing's worth 50 cents now, let's just say hypothetically. I would then roll it up to let's say, $1.50 out of the money. Let's say I get 74 cents, right? Because this strike would be all the way up here, right? And they'd be paying this amount, okay? So I would end up rolling it for about the $13 strike, which should be paying about this, maybe a little bit more, 80, because it's higher, all right? And that would immediately cover my $25 loss, and that would give me back more than I was going to get before. So I'm still in the game by rolling this position, right? And I could just hit continue. We're going to pretend this is a $13 strike, and I could roll it. Now that it's further out of the money, and I'm selling one a buck out of the money, I could then turn it into a debit spread if I wanted to, right? And I can also roll that debit spread if I'm bullish. Then from there, let's say I'm selling the 13, all right? I could then buy we're going to come over here. After I roll the position, then I could come over here. So that's a sell, and I could buy a 12.5, right? That would virtually turn it into a debit spread. They can be separate, and that would free it from those shares. From there, you can mitigate what you want to do with it. If it tanks, you can close the sell side out, and now you have a call, right? That didn't cost you very much money. The difference between 12 and 13 is what? That's 6. Look at the price right now, because we're speaking hypothetically. as if it were to be at 12. So these are going to be paying more. But as of now, they're not that far off, right? They're 6 cents. In reality, they're probably going to be about 20 cents off, right? So, and if the equity ripped that much, you've made a clobbering amount of money. So the fact that it's off a little bit isn't going to make that, uh, you know, taking a $20 hit. If you think that it's going to rip, another 30% on the shares, 10%, it doesn't really matter that you took a $30 loss because, that's to say worst case scenario. Best case scenario, it starts to really shoot up and you freed yourself from the covered covered call, and now it's a debit spread, and you can mitigate those options on your own and adjust, right? So now you've freed it from the shares, and best case scenario, it keeps going up, and you can close the sell side out, then the buy side, right? I can buy the closer in, and that further out is a sell, right? That's a debit spread. Remember, debit spreads, we buy the further in, and we sell the further out, okay? And this is what's so good about the sell side is I can mitigate. I could always mitigate a position if I don't like it, if I'm losing, if I'm winning and I want to reduce risk, right? And then I'm good. Right? We wouldn't want to do a credit spread because that's basically almost the same thing as a covered call where you're in a buy position and you're selling a position, right? We'd want to turn it into a debit spread, a debit position. If you really believe this thing's going to rip, right? I can buy a call against, we're going to pretend I'm selling the, the 13 and a halves. That would be a sell, right? Let's go back here. Let's get rid of this. Because remember, I rolled it out, and then I'm buying the 13s, but it's going to be priced around these contracts right here. If these shares went to the strike, then I'm selling. Remember, I rolled it, right? 13 and a half. I could have even done something different like this, right? If I rolled it, if it's at $12 and I'm selling, remember I rolled the position to a sell from the $12 to the $13 position because it's at 12 and I don't want to lose the shares, right? So I'm already in that position because of the roll. And now I'm going to buy right at the money, the 12 and a half. Now, if it stayed at those prices, my max loss is what? Is 9 cents, right? What does that matter? If the shares rip that hard, I'm up like $150. I'm up more than that. If I bought it at 9, I'm up, let's see, I'm up a couple $100. What the hell does it matter if I took a 9-cent loss, right? Ooh, my whole world's over. It doesn't matter. So, and if it keeps shooting up, I'm going to get paid. Not a lot because the debit spread's tight. So this is one method that we could do. To try to type this out in a Discord is like impossible for people to understand. You advanced traders, and those people that really know how to manage a position in a portfolio, this is an advanced way of doing it, right? The sell side is very technical, and you learn so much being on the sell side. Building a portfolio through selling options, mitigating risk through selling options, hedging not through buying, but through selling. I don't want to buy more options as a hedge because I'm just exposing myself to more theta decay, right? So I can keep going. I can keep going more. You asked me to explain more and other ways to mitigate it. I can do this on the cash secured put side too. You all just asked me to make a video. So to wrap this video up, because this is very hard to explain and it's very hard to get with me talking and showing you on here without actually doing it, right? Maybe we should do a video when something's not going my way and I can then turn it, it's starting to lose, and I can turn it into a win and reduce and eliminate my risk, right? But this is to wrap this up. There's 2 ways to go about it, okay? The first way is rolling the position. Okay, I'm selling the 12 strike. I don't want it to hit 12, and I don't want to be called out of the shares and have them bought back from me at 12. I bought them at 9.80ish, so it would be a fat win. But hey, I think that Mara's going to go to 20. hypothetically, I'm going to roll this position to a further out date, further out expiration, right? And I'm going to sell that option, right? Now, since I'm selling the 12, I'd probably want to roll it about 2 strikes out. And I would hit continue, review order, and I would hit submit. After I did that, I've now rolled the position. I've covered my losses and received more money back. So now I'm back in the game and I'm green. So now for me to lose the shares, have them bought from me, it would be at 13. Now I still own the shares, but let's say I believe it's going to go higher. Okay? I buy a call against it. Okay? I sold the 13. I can buy the 12 and a half. So the first way is rolling the position, just rolling the position, period. Okay, the way I just showed you is a debit spread. So again, the first way, if I don't want the shares called away from me, is I roll the position to a higher strike, further out expiration. It can't be the same expiration or it's a loss. You're realizing a loss. Further out expiration, further out strike. That's way number one. Way number two, if I really think this thing's bullish, then I buy the closer in strike and turn it into a debit spread. 2 options. Roll it to a further out strike, further out expiration. Then, if you really think the second option is to turn it into a debit spread, a very tight one. Okay, and you may end up making more money because that thing's going to explode. Then when it explodes, I can sell the debit spread in profit. I freed myself from that covered call. And then whenever I think that it's topped out, I'll sell a new strike way, way out of the money, way, way out expiration, further out expiration, right? Doesn't have to be. You can assess where it is. I'm speaking hypothetical here. So those are the 2 ways. There's another way by making it a calendar, right? By doing a calendar spread, which is a bit riskier. But there's always a way out on the sell side. So I hope this video helps.